afternoon, everyone. My name is David Scherer. I'm co-CEO and co-founder of Origin Investments. I'm here today with Tom Briney, who I will introduce in a moment. He's a managing director, works out of our Denver office, covers the West, also the portfolio manager on the Multifamily Credit Fund. We are now in our second year of the fund. I was told right before the webinar that about 25% of the attendees, we had just over 200 registrants, are partners currently in the fund. So for those of you who are partners, we will provide an update. The fund is performing extraordinarily well, doing exactly what we intended. And then 75% are actually new. So we're going to spend a little bit of time talking about what Freddie Mac does and what B pieces are, the collateral, the strategy. So even if you're a current investor, I think you'll enjoy the refresher on what exactly it is we're doing and why. A couple housekeeping things. For those who sent in questions prior, we received a couple dozen. Thank you. We'll incorporate it into the presentation, and then we will also answer some live. There is a Q&A feature, so if you have any questions throughout the presentation, shoot us a note in the Q&A, and we intend to spend about 20 to 25 minutes of the hour answering questions. And that's true of this webinar, but really all of our webinars, we prefer it to be interactive. So with that, I'm going to get started. A little bit about Origin. It's important because we're obviously the manager. You need to understand us as a business. We have 40 team members. Most are in Chicago. That's our hub. But we also have a presence throughout the country in all of our target markets. We're a multifamily investor only. We have about 10,000 units either that we own or are in development. And in our regions, which I would characterize as the Southeast, Texas, and the Southwest, we have offices throughout where people live and work. Tom is an example. He runs our Western operation, and he also lives in Denver. We think that's important. It's not different. It's better to have people who live and work in their markets. They just understand them better living there at a more granular level. And they also form deeper relationships, which are really important in real estate. In terms of Origin, the company, we're a top decile manager. I'm extraordinarily proud about that. If you look at the footnote, a lot of the times footnotes are an afterthought. I think it's actually really important. We say top decile, but the reality is we're 11 out of 262 worldwide real estate managers, which puts us at about the top 3%. We just say top decile. It's easier to convey that way, but it's much better than that. And the other thing I'm proud of is it isn't for a fund. It's actually for everything we've done since 2014. So it actually straddles 4 funds. That's Fund 2, Fund 3, our Income Plus Fund, and QOZ Fund 1. All of that work is cumulatively in this data. And so when you're thinking about investing in a strategy and a manager, what you're looking for is consistency of excellence. And that's what I'm proud about there. The 2.1 average equity multiple simply means on average, if you invested $1 million at Origin, you earned 2.1 million. Of course, the million was a return of your capital. The 1.1 million would be your gain or your profit. 24% average gross IRR, again, across all realized investments. And then in terms of assets under management, we state 1.4 billion. The reality is that doesn't take in consideration our development pipeline, which is one of the biggest in the country. That number will be much closer to 3 billion in the next year. Alignment is very important to us. So myself and my partner, as well as our senior management team, Tom Briney, Dave Welk, Mark Turner, and many others, Michael McVicker, our general counsel, we've all cumulatively invested 65 million into our funds of our own capital. That's proven to be a very good investment for us and our investment partners. And we'll continue to do that. It's important that your manager is aligned. if there are RIA, registered investment advisory firms on the call, we have over, it says 50 here, we have 52 approved RIA firm partners at this point. And in terms of total investors, and that's active investors in one of our funds currently, we have 2,500. And what's interesting about that is it's homogenous in the sense that we're all taxed. And so not only are we trying to deliver the best return, we're trying to deliver the best risk-adjusted return. We're also trying to deliver the best tax, after-tax risk-adjusted return. And we'll get into that in this fund, which is structured with a subsidiary REIT to reduce taxes 20%, as an example, on dividends. If you weren't a taxed investor, that wouldn't be important to you. But importantly, all of our investors, including myself, my partner, our senior management team, we share the same goals. Next slide, please. So let's jump into the multifamily credit fund. And before we talk about the what it does and how it does it, let's talk about the goals of the fund and why you as an investor would be interested in the fund with these characteristics. The number one reason is the downside protection. This is really the perfect market environment to talk about this as a part of your portfolio. Prior to Russia, Ukraine, we were having a market correction driven by the risk-free rate going up. The Federal Reserve unwinding its balance sheet, decreasing its balance sheet, raising rates. That was January. Now it's that in addition to inflation, Russia, Ukraine, oil prices, more inflation. So there's a lot of uncertainty in the market. And I would argue that you want to have some of your portfolio that you're actually not worried about in these market environments because it's an essential asset. Multifamily rentals, we have tremendous amounts of data that Tom will get into. Other stress test environments like the recession of 2000 to 2002, the Great Recession of 2008 to 11, COVID. There's just an awful lot of data that shows you there's not a whole lot to worry about in this strategy. And that's why it's such a significant part of my portfolio as well, is I want that downside protection and components of my personal portfolio. The other thing I'm looking for is monthly income. I have a lot of growth investments, both at Origin and elsewhere. I wanted to have part of my portfolio that I could count on a 6 to 8% yield payable monthly. And so that was important to me. And then in terms of a built-in hedge against inflation, lots of these bonds, not all, but lots of these bonds are priced as a spread above SOFR, or formerly known as LIBOR. So what that means is as the Fed is raising rates, your interest rate is going up in lockstep with the new higher short-term rate. So right now, LIBOR and SOFR are virtually zero, but the market believes that in a year they could be 150 basis points higher or even more. In this world, your yield would just go up in lockstep with the increase. So you're very much hedged against future rate increases in this, which we like as well. That works out to a 6 to 8% target net yield that's payable monthly, but obviously on an annualized basis, 6 to 8%. The net multiple is just a function of the total return and the duration target, which is roughly 6 to 8 years, the fund. And you're talking about a 1.6x. When we quote a net, and we are, that means net of all fees, net of all promote. That's what's payable to you. When you're looking at any fund, it's really important to make sure that the manager is quoting net, and not gross. Net means what's payable to you after all fees. And then an 8 to 10% target net IRR to the investor. And Tom will get into why the yield is slightly different than the total IRR. That's a function of some of the positions are accrual, and they provide you're buying the bonds at a discount. Next slide, please. This fund, as I said, has been launched, and we have about, I think, 14 months now of activity to report on. And it's mainly, these are the portfolio holdings. And so I'll go through Freddie Mac. I'm on the right side right now. But just to sum, when we say 0 assets on the watch list, that means assets are loans. That means there's no loans that obviously are in default. And not only that, there's no loans that are even on a watch list, meaning they're not in default, but they potentially could be. We don't really even have any trouble on the horizon at this point. 1.86 average debt service level means at the property level, they have 86% more cash than they need to service the debt. So if they start, if rents were to go down or expenses were to go up or vacancy were to increase, anything that stressed the asset, you have just a massive amount of cushion before you can't service the debt. And ultimately the debt is what provides us our dividend. We get those debt streams. That's what pays us. And then weighted LTV. LTV is short for loan to value. That means that of the bonds we hold, the loans are on average a 60% LTV. What that means is the asset can go down by 40% in value before it affects us or the debt, right? So in other words, there's a massive amount of cushion. And what's important to note is we're talking about multifamily. If we were talking about hotels, we were talking about office, we were talking about retail, you could reasonably say, well, you know what, if there's a recession, things can change, LTVs can get hit, demand will go down. The reason Origin is in multifamily, not just in this fund, because the collateral of all these bonds, the loans are made on multifamily. It's all we know, it's all we do. That's a proactive decision we made a dozen years ago. And we're in multifamily because it's the least volatile asset class in real estate. And that should make sense to you. When a recession hits, you don't have to go on a trip. You don't have to go out to eat. These are all discretionary consumptions. You do need a place to live. And it's played out again and again and again over 30 years. We have 30 years of data will show you. People pay their rent. They cut back everywhere else, but not here. And so if you believe that we're entering slower growth, I would tell you multifamily is the best real estate asset class to be in. And this specifically is the best strategy to be in because you're also getting further protection from the low LTV, your protection in the capital structure itself, in addition to the asset class. So some of the seed assets, the first bond we purchased was Freddie Mac KF96. That was a $25 million investment. I believe Tom's going to go into deeper detail, but this particular investment, what's important to note here is it's providing an 860 over SOFR yield. The current market in this is sub 5%. So another way of saying this is deeply, deeply in the money, and we're not marking up the value. So for those of you who partnered with us, you've already enjoyed this huge benefit. But we're still extending it to new investors as well. We don't mark up assets. If you join the fund, you get that bond as well. Freddie Mac K747, we're not going to mark that up either. That was purchased at 835 unlevered. This isn't priced over SOFR. Nonetheless, this would trade 20% higher in today's world. We're not marking that up either. So you can maybe approximate the math, but I would say 35 to 40% in the money on KF96, 20% on K747. And then we also, as a fund, own 5 IO strips. Tom will describe what an IO strip is, but these are mainly purchased for liquidity to the fund, although they do have good yield and good total return expectations. We bought these on the primary market, so they generally come with about a 10% edge. And before I introduce Tom formally, I want to tell you that the biggest picture here is if you're a primary buyer of Freddie Mac bonds, you're getting a 10% edge all the time on new issuance. And that's what's so interesting to us here is being a primary buyer, you're getting an edge all the time, which we can pass on to you. And that also exists in the IO strip market. So with that, I'm going to introduce Tom. Tom Briney has been with us for well over 11 years now. He joined us from Blackstone Equity Office. He has been absolutely prolific in terms of deal sourcing, multifamily, but he also brought Freddie Mac case series strategy to me about 2 years ago. And it was an opportunity that was interesting because it was exactly what we do. We focus on multifamily. This is 100% multifamily as collateral. And so at that point, we dug really deep into it. We've been in discussions with Freddie Mac for over 2 years. It's a very, very difficult market to break into because Freddie Mac wants to know that the buyer of the B pieces understand multifamily, know how to own it, know how to operate it, and importantly, have scale throughout the country, which Origin does. They want the B piece owner to have real expertise and to protect the entire bond. And so we've been working really hard with Freddie as a partner, and we really value them as a partner. Going forward, we'd like to do this for decades. So Tom, I'm gonna turn it over to you, and he's gonna take you a little bit through what the bonds are, what the B piece is, and how we are approaching it. Thank you.
Thanks, Dave. You spent a lot of time selling everybody about how great the product is, but let's spend a minute because we've got about 3/4 of participants on the webinar today are not current investors. So I'd like to spend a minute talking about what the actual investment is. Freddie Mac, when they originate loans, they pool them together into a larger pool. That's what we're seeing here, this 800 to 1.5 billion. That's a larger pool that's made up of multiple Freddie Mac loans, Freddie Mac originated loans. And they range anywhere from 30 to 50 loans per pool, but they can be as few as 10 and as many as 175. But generally speaking, Freddie Mac targets a bond pool of between $800 and $1.5 billion total. They then split that pool up into two pieces, the A piece and the B piece. The A piece is about between 90 and 95% of the total bond pool. So a very, very large portion of the pool, well in excess of $1 billion usually. And that piece, the A piece, is federally guaranteed by the US government. It is generally getting returns of slightly above the corresponding treasury. So call it 10 to 15 basis points, sometimes 20 basis points above the corresponding treasury. In a 10-year bond, that'd be the 10-year treasury plus 10 to 20 basis points. Very narrow returns, but that's logical because that piece of the bond is federally guaranteed. So you should be getting similar to the risk-free rate. Similarly, the B piece, which is anywhere from 5 to 10% of the total bond, a much smaller piece, is what Origin is investing in. It's not rated, it's not federally guaranteed, and it is the first loss position. And for taking that risk, the lack of guarantee, the lack of rating, and the first loss position, rather than getting 10 to 20 basis points over the corresponding treasury, you're getting 500 to 700 basis points over the corresponding treasury. So substantial compensation for taking that risk. But it depends on what type of product we're investing in. And I've listed some of the product types below. There's floating and fixed, which Dave has talked about. We've invested in both. The KF96 is a floating rate bond. The K747 is a fixed rate bond. We've also invested in SBL and IO strips. And each one of those has a different return profile, a different risk profile based on the underlying collateral, the underlying sponsors, and the position within the capital stack. With that risk profile, what does first loss actually mean? Jeff, let's jump to the next slide. First loss is outlined a little bit better here. The senior loan, the A and the B piece together, as you can see in the bottom 2/3 of this chart on the right, represents about 70% of the total capital stack, or what the property was purchased for and then financed. The 70 to 100% noted at the very top here is the cash that the borrower of the underlying collateral invests at their acquisition of the loan, or of the property rather. So on a $10 million investment, $10 million purchase of a property, the borrower will invest about $3 million, or from 70 to 100% of the loss position. Before Origin is exposed to any losses, that entire 70 to 100%, that 30% cushion there needs to be wiped out. Said differently, the value of the property would need to decrease by 30% before Origin experiences any loss at all, or the credit fund experiences any loss at all. This then becomes Origin's piece, and the loss occurs prior to any, Origin would be wiped out entirely before any A piece is lost. Over the history of the program, no B pieces have been wiped out entirely. And that you can see here. The worst case scenario, represents 28 years of loss history for the Freddie Mac program, starting back in 1994 when the first Freddie Mac originations occurred, through 2020, which is the last full year of data that we have available. The average loss across that 28-year history is 0.076%, with the worst loss vintage being less than 0.5 of 1%. That's the 2006 vintage. It's worth noting at this time that these are the vintage years of the origination, not the years of the loss. But let's spend a minute looking at 2006. So 2006 is the year in which the greatest loss was recognized as a percentage of the loan origination. In 2006, we had about 11.5 billion of origination that year, which resulted in 50 million of total losses. Now, most of those losses actually occurred in 2008, 9, and 10 during the Great Financial Crisis. So after, 3 to 4 years after the originations occurred. But what's interesting about that is when you take into consideration, if you were to have invested all of your fund in 2006 vintage, your net total return would still have been about a 7% IRR unlevered, because of the cash flow generated before the losses, the limited amount of loss, and then the cash flow generated after those limited amount of losses. In the worst case scenario, you're still generating a healthy positive IRR, which is really what got Dave and I most excited about this program, is that the losses have been so small over the years and the returns have been very healthy for the risk that's being taken here. Let's jump to the next slide. So why is it that everybody doesn't jump into this program? As Dave mentioned at the beginning, this is a very challenging program to get into, because Freddie Mac wants to make sure that you are a partner of Freddie Mac, not just a trader or acquirer of these bonds. And so the underwriting process from Freddie Mac is very thorough. Right now, there are about 20 groups in the program across the world, frankly, that have access to buying from Freddie Mac directly. And that's by design. Freddie Mac wants to know who they're working with, and they want to know that they can be working with that group for a very long period of time. So they've set up these 4 legs that they focus on when they're underwriting a group, including Origin. The first is operational expertise. Does the group who is partnering with Freddie Mac have the ability to run and operate real estate multifamily properties? Because as Dave noted, we have about 10,000 units either owned or under construction right now, plus more that we've sold over the last 12 years. We have tremendous operational expertise. And that's really also a function of the top decile performer is demonstrated through our operational expertise, our knowledge of how to operate the properties, how to collect rents during challenging times, when to push rents, when to push occupancy. Freddie Mac has dug exceptionally deep into our operating history and our operating knowledge, and they have approved us from an operating perspective. The second piece is they want to understand if we're a Freddie Mac borrower. It's important to them that we know the ins and outs of Freddie Mac as a lender, and they spend a lot of time underwriting Origin to make sure that we are a Freddie Mac borrower. We've been borrowing through Freddie Mac since 2010 as a firm. We continue to borrow through them, and we will continue to borrow through them. They're a lender who is there through thick and thin. When the world gets tough, Freddie Mac is still there. And that's extremely important to us as a multifamily borrower and operator, to have a lender who's there at fair terms at all times. And so Freddie Mac has proven that to us over the last decade plus, and we will continue to borrow through them. That's extremely important to Freddie Mac to know that we aren't just taking advantage of the B-Piece program, but we're also participating as a borrower of Freddie Mac. And really the biggest B-Piece buyers in the program are also the largest borrowers as on the underlying collateral. That's the Blackstones of the world are big borrowers of Freddie Mac, and they're also buyers of BPs. The third piece is the significant capital base. That's why we're on this webinar today. These investments are not small. Generally speaking, we're looking at between $25 and $60 million per bond investment, sometimes a little bit larger, sometimes a little bit smaller, but that's a fair range. And so in order to continue to be active in the Freddie Mac program, you need to have cash on hand at all times to participate in their rotation. It's also important that to have cash on hand so that there is a healthy secondary market for the B pieces. And when there's an outlying scenario like we had in March of 2020, and there's some volatility in the market, there's an opportunity for us as an approved buyer of these Freddie Mac B pieces to acquire them at attractive rates. And so a significant capital base is something that we're focused on all the time. We are currently raising, we'll continue to always raise for these funds so that we can be active at all times, good and bad. And then finally, Freddie Mac wants to know that you're a long-term holder. That is a pretty nebulous concept. As Dave noted, the edge on the acquisition from Freddie Mac, directly from Freddie Mac, is anywhere from 10 to 20% versus fair market value in the secondary market. And they want to know, Freddie Mac wants to know that you've acquired the bond for your portfolio, and not that you're going to flip it out tomorrow and generate that 10 to 20% benefit day one. Again, they spend all this time underwriting us, Origin, as the buyer of these B pieces because they want us as a partner. They don't want us going out to the secondary market tomorrow and generating that arbitrage. They want to know that we're long-term borrowers. If something happens and a year or two in, you need to sell a bond, that's totally acceptable. As long as you're not regularly flipping within a week, a month, a year of your acquisition directly from Freddie Mac, that's what they're concerned about. So there is a vibrant secondary market to this. You have all the leeway in the world to participate in that secondary market as a primary buyer. You just don't want to be doing it on a regular basis the day after you acquire and really just play the game against Freddie Mac. Let's jump to the next slide. Dave touched on this briefly, but I'm going to go a little bit deeper into what the bonds are in the fund today. The first is one that we acquired in January of 2021. That's that first one on the right, Freddie Mac 2021 KF96. This is a 10-year floating rate bond. Again, we acquired it in January of 21, which means the loans were actually originated between October and December of 2020. If everybody on this phone or on this webinar recalls, the underlying collateral at that time had taken somewhat of a hit because of COVID from a valuation perspective. So when these were appraised at acquisition, at origination, there was at 71% loan to value. But today, that's probably closer to 45 or 50% loan to value. And that was in the piece that Dave touched on earlier, is this is deeply, deeply subordinated from an equity perspective, meaning, said differently, in reality, any of the underlying collateral, before it was really eating into Origin's position, the underlying collateral would have to decrease in value by almost half or maybe more, depending on the asset, before Origin exposed to any losses. That, in conjunction with the fact that it's generating a LIBOR plus 860 basis point spread, or today about 9% unlevered yield, a little under 9% unlevered yield, gives us, and this is one of the best risk-adjusted returns that I've seen in any investment opportunity, let alone in credit. Now, what we're seeing because of where asset values have gone, the original loan count was 49. If you were to flip back up to that third slide, there was slightly lower equity invested than our original investment. It's about 20 million today versus 25 of the original investment. That's because some of the loans have begun to pay off. That's as folks move through their business plan, and we have returned some capital to our investors of the fund so far, because that loan count has decreased from 49 to about 38. But that is the original loan count. And you can see on the left on both of these, the geographies. As Dave noted early on, we've got offices across the country. And what's interesting about KF96 is that the top 4 geographies, Arizona, Georgia, Florida, and Texas, are all markets where we invest actively on the equity side. These are markets that we know intimately. And so when we have a bond like KF96 come across our desk, And it has the equity protection that we're talking about. It has the yield that we're talking about, and it has the geographies that we're exceptionally comfortable with. Feel really good about that. Similarly, this K747, which we acquired in January of 22, so about 45, 60 days ago, is another asset that we feel very good about. This one is similar to the above, is a much lower leverage piece. We're at 63% at origination, and as the values of the underlying collateral increase, that loan to value will decrease correspondingly. So 63 will become 55, will become 50. The difference in this bond is that this is a 7-year fixed rate bond. So rather than acquiring it at par today and generating yield, this is acquired at a discount to purchase price and generates very little yield. So on the first page, we noted that we have about 22 million of investment in this. The par value is actually 50 million, 53 million. So over the next 7 years, that 22 million will accrue in value to become 53 million, and the yield on this will be substantially lower. So KF96 is L860. This one's going to generate about a 2% yield current pay over time, but over the life, the 7-year life, will generate an 8.5% unlevered IRR across for this particular bond. And the reason we do a blend of the fixed and the floating, we'll talk about portfolio allocation a little bit, is the yields between 21 and 22 have compressed. And so you need to lever in as a portfolio manager a blend of fixed and floating, the accrual versus the current pay, because the accrual tends to have the higher total return relative to the floating rate. So the floating rates today are in the mid 5s, SOFR plus 5 and change, and the fixed are still in that 8.5 range. So there will be a blend in our portfolio of the two asset types. From a geography perspective, again, this has a lot of exposure to California, which we didn't see in the 2021 vintage. That's because in 2021, California was being hit pretty hard from COVID, from the lockdowns, California and both New York. K747 has almost no exposure to New York, which gives me a lot of comfort as well. California has rebounded substantially quicker than New York has. So I feel comfortable with this California exposure. Plus, where it's the actual assets, there's 4 assets located in California. They're extremely well located in the San Diego market, which has been one of the faster markets to rebound in that geography. And then Florida and Texas, they're markets again that we cover. We have offices in both markets, and we feel very comfortable with the collateral in those underlying markets. So I'm going to pass it. Oh, I'm sorry. I'm going to go on to the portfolio allocation. Jeff, if you want to go to the next slide. This is the existing portfolio set a little bit differently. We're about half fixed, half floating, a little bit of cash, and some IO strips. Our current yield is just about 6% today. As we layer on more floating, that yield should go up to that target 7% that we've referenced before, but we're right at the low end of our target total yield of 6 to 8%. And we're right on with our total return, maybe slightly above on our net 8 to 10 total return. We should be well on our way to generating those target returns. Jeff, the next slide is our target allocation. The unique part about the target allocation is it's very difficult to nail these percentages on the head. So there are several different ways that we can get product. The preferred way is directly from Freddie Mac through the rotation program and through buying the IO strips through the primary dealers, being JP Morgan, Wells Fargo, et cetera. But there is a little bit of leeway that needs to be understood with this, because as a good partner with Freddie Mac, and because we're getting that edge, you can't always dictate as a fund manager exactly what product you want and how much of each product you want. So we're targeting here about 42% of the total $250 million portfolio to be floating. But in reality, it's going to be challenging for us to nail that 42% on the head. It could be 38, could be 50. It's going to be something that we're targeting, but there will be some leeway on that based on what Freddie Mac is able to provide us. And that's really a function of what Freddie Mac is able to produce from an origination standpoint. And that changes year by year from the borrower's expectations of what the capital markets are going to do. And a quick example of that is in 2021, in the first half of the year, there was a tremendous amount of floating rate product being originated. It was about 60% floating and 40% fixed. And as people's expectations for interest rates increasing began to change, borrowers shifted from the floating rate scenario to the fixed rate scenario, and now that is inverse, and we're about 60% fixed rate origination and 40% floating rate origination. So we're a little bit at the whim of Freddie Mac, what they're able to produce, and then our expectations of what Freddie Mac can give to us. There's some ability to supplement on the secondary market, as I noted earlier, but these are really target allocations that should be expected as such. So when we've got a $250 million portfolio allocation and we show 50% floating rather than 42, hopefully nobody's too upset because these are, again, targets, not actuals. The next slide, Jeff. So I'll pass this over to Dave now and talk about the Reit structure of the fund itself and how that's advantageous relative to other credit products as a real estate program.
Thanks, Tom. We're right on schedule too. I mentioned earlier, all our investors are tax investors, 2,500. We all have the same goals. And so part of the 2017 tax law was that if you structure subsidiary REITs on funds with real estate assets, such as this is considered a real estate asset. It's real estate loans. You receive a 20% discount, reduced tax rate on dividends. And so here we're using a hypothetical 37% ordinary income tax rate. Of course, yours could be lower than that, higher than that. But the 29.6 is just a 20% reduction there. It's just significant because 6 to 8% of your 8 to 10 total return is dividends. And all bond investments are taxed at ordinary income. This is no different. That's one of the challenges with bond investments, fixed income investments. But here we can mitigate 20% of that, which is really extraordinary. So my position, I believe this, as one of the largest investors in this fund, first of all, it's the highest risk-adjusted yield in credit. The reason is, and Tom went over this, it's so hard to break into the market. There's real barriers to entry. If you want to buy a muni, go buy a muni. Anyone can do it. If you want to buy BP's K-Series, you can't. If you're a sovereign wealth fund, you can't. If you're a family office, you can't. If you're a hedge fund, you can't. And that's why the yields are outsized. And we have a lot of these iterations of this question, why? Why are the yields so high relative to the historical loss ratio? And the answer is barriers to entry. It's real. We had every single thing Freddie Mac is looking for at origin, and it took us almost 2 years to get into the approved buyer market. That's called a barrier to entry. It's a big deal to have exposure to this market. Tom, did you have a chance to talk about the rating on the fund?
I did not. That's coming up shortly here, but you're welcome to touch on it.
Yeah, no, go ahead. You can do it.
No, please. Yeah.
No, you're tired of talking. I got it. So we had the fund rated, and this is really, we got a lot of this question, some iteration of this, because these aren't rated. These bonds aren't rated. We could always point to, they're not rated, but you're looking at, loss history since 1994, and there just simply haven't been any. And you're talking about, billions and billions of dollars of loans with real stress tests. The Great Recession was a real stress test, and it did just fine. So we had it rated by Egan-Jones, and they went through a pretty in-depth process of looking at the collateral, looking at the loss history, looking at the debt service and the LTV, all the stuff we mentioned, but also underwriting origin. Because anytime you are investing in a fund, you're investing in the strategy and the collateral, but you're also investing in origin. So what are we as an entity, as a going concern? And so all of that considered, it received an A- rating, which you can use to compare it to other A- rated products. So if you think about multifamily credit fund, this is on the right, that's your target yield versus single A rated corporates, single A rated munis. Of course, munis have a tax benefit, so you have to equalize for that. But you're talking about a massive spread. The other thing I'll say is this year thus far has really borne this out even more. This collateral, these bonds, these V pieces, they're actually in so much demand right now that the yields are actually going lower, while every single other element of credit, the yields are going out. And in some cases, quite significantly. So people on this webinar are in corporate bonds or preferred equity, bank loans, all of these are down anywhere from 5 to 10%. And that really shouldn't happen, but it is. This is truly an uncorrelated product. It's not correlating with the market. It's doing exactly what it's supposed to do as a function of your portfolio. You don't want a portfolio where everything in your portfolio goes the same way at the same rate. That's exactly why I'm so heavily invested in this. And the market's speaking. The flight to quality is actually here. That's where the money's going. Next slide, please. So the summary terms, I'll go over this, Tom. The minimum investment is 100,000. The other thing I want to be clear on is you have to be a qualified investor to invest. So most of our funds, it's just accredited. Qualified means that you have $5 million of net worth. So it's a higher standard. So our partners in this fund have to meet that criteria of qualified, not just accredited. The GP, that means the management. We talked about alignment before. This is our most aligned fund. The management has 30 million of its own capital in the fund. And of the GP, I'm the largest member of that group. And I explained why. The first close was last September. The final close will be this September. Our target is around 200 to 250 million. If we reach that raise sooner, we'll stop the raise at that point. An important feature of the fund is the liquidity feature. And the reason we put this in is using myself again as a litmus. I would like to have access to liquidity because I'm using this as cash management for me. And so the liquidity function means that 10% of equity in the fund can be redeemed annually. And you would just notify us. This is all in our PPM, and you should review it, but there's a notification period where you will let us know how much, et cetera. And then once a year, you're afforded the opportunity for 10% liquidity. This is not normal in a closed-ended fund. I've never been in a fund that provides this, but we wanted to do this. And importantly, we have enough liquid assets. Tom talked about earlier how a lot of the assets Freddie Mac doesn't want you selling. The IO strips you can sell, and it is a liquid market, and that's why we own them. We own them to provide liquidity for redemptions, and that's why they provide yield, but also liquidity. Tax reporting, this is a great one because we got a question emailed prior. Yes, you receive a K1, you do not receive a 1099. This is a partnership interest. So our accounting team is very good about getting those out on time for all of our funds. It's a huge effort that they do it so that you have ample time to file in April your own taxes. In terms of fees, the performance fee, I guess I'll start with the management fee. It's scaled. So if you're an investor from 100,000 to 999,000, it's 1.35% per year, and it scales all the way down to 0.85% at 15 million or more. If you're an investment advisor, we have a lot of partners in that space, in particular for this strategy, because it's a good fit for your portfolios. We pool your clients. So if you have 10 clients who enter the fund and cumulatively they have 15 million between them, then all of them will receive 0.85. That's something that we do for our partners there. The performance fee is a 10% performance fee above a 7% preferred return with a 50-50 catch up. If you have questions about what all that means, happy to jump on a call or email me or Tom, and we can take you through it. I do want to answer questions live, but if you have questions about what a performance fee is, what a preferred return is, what a catch-up is, just email me at david@origininvestments.com, and I will be accessible to answer those questions. I will say that on the fee side, we're the lowest fees in this space. We have 3 or 4 competitors. We price 20% below them because it's a new fund. We're not a new firm. Obviously, we've been around for quite a while, but it's a new strategy. So we wanted to make sure that we were the most friendly in terms of fees, and we know that we are. All right, I'm going to. We have 5 questions, and Tom, I'll steer, but I'm looking at my phone because I'm looking at the emailed in questions, and I'm just going to knock out a couple real quick. One of the questions that was sent prior, actually, you can answer this, Tom. So we're providing a 6 to 8% yield, an 8 to 10% total return. The investor that sent this in prior, his question is, how does that work with loans that are made by Freddie at 3 to 4%? Like, how does the math work?
Great question. That's also how the answer to this is also how Freddie Mac gets paid on this. So as I noted earlier, there's a big disconnect between the A tranche and the B tranche. And this is a little bit of algebra, but let's just say that the underlying collateral average 10-year fixed at 3% is the underlying collateral average, right? The 10-year loan, the A piece acquires the portfolio, 95% of it, at the 10-year treasury plus 10 basis points, which today would be about 180 basis points on 95% of the pool. That leaves a huge percentage of the pool, a huge percent of the interest income that's being sent to the pool to be paid to the B piece buyer. And so there's an auction each year. This is getting into details a little bit more than this webinar, but there's an auction each year to set the pricing for that B piece. And the spread between the A piece and the B piece is what Freddie Mac takes. So they're incentivized to have a lower B piece yield, and the B piece buyers generate that higher yield because really half of the interest income, about 40% of the interest income from the underlying collateral is allocated to 5% of the bond, the B piece. And so really there's a huge amount of excess because the A piece being federally guaranteed is such a low total return that a huge amount of those interest payments are able to be allocated to the B piece.
All right, I'm going to answer another question, which is, do we have opportunities to invest via IRAs, 401ks? Do you have approval at firms like Fidelity and Schwab, et cetera? The answer is yes to all of that. Because we have so many registered investment advisor clients, we've been approved on all these platforms, Pershing, Fidelity, TD Ameritrade, really all of them. So yes, and then in terms of investing through a 401k or an IRA, you absolutely should if you have the ability to do that. So number one, you need to be a qualified investor, 5 million in net worth. Number two, if you have sizable 401ks, they can be approved. This can be approved as an investment for it. Same with IRAs. We do that with all of our funds, but candidly for this fund, it's the most effective because although we have a subsidiary REIT and it's more tax efficient than anything else in fixed income, it's still fixed income. You don't get depreciation. You don't get some of the tax avoidance strategies of real estate that are afforded you by our other funds that are much more tax efficient. So if you have a tax efficient vehicle, a foundation is another amazing place. We have a family office investor in this fund that's partnering with us. They have a sizable foundation. Obviously, that doesn't pay taxes at all. Okay, I'm going to switch to live questions, Tom, and we have some good ones. Terrence, thank you for your question. This is a great one. How do you analyze and underwrite the individual loans that comprise these bonds? Tom, you can take that because I know you spend an awful lot of time on it.
Absolutely. And I think we could do an entire hour webinar on just the process behind it, but I'll keep it very high level and give you a sense of how deeply we dig. Really, we start with, and we haven't touched about this at all, but we have an AI machine learning platform that we've been building over the last several years that is highly, highly accurate in predicting rent growth and predicting market movements. over time. And so the first thing I do when a new bond opportunity comes in, I put all of the loans into this AI machine learning platform, and I ask it to flag any high risk loans based on geographies. A lot of times, some of the underlying collateral can be in secondary or tertiary markets that, although they're in Colorado and I live in Colorado, I may not know the exact nuances of some town that's small in the Western Slope. The AI machine does know that stuff. And so that's the first place I stop is, let's look at where the AI thinks there could be issues. And I take a really deep dive into those individual assets, the sponsors, the underlying collateral, the debt service coverage, and we really take a hard look at that. I then take a look at, from a higher level, if there's any repeat sponsors within the pool. So any sponsors who have 2, 3, 4 loans, because the underlying collateral in itself is a great hedge because, as Dave noted, it's a required asset. People need to live somewhere. But what's not required is to have a good actor at all times. These are generally institutional borrowers. But if something happens across their portfolio, even some of the best institutions have risk allocated to their sponsorship. So I spend the next tranche of my time digging into the sponsors, understanding who they are. A lot of them are the Blackstones, the KKRs of the world. So that, that doesn't require any additional digging from my perspective, but I want to know who is the guy who has 2 $10 million loans who I've never heard of before, and really dig into them, understand their operations, understand who they are. And then I dig into the actual underlying collateral of everything else. When was it built? What does it look like? Has it been renovated? Are they planning a renovation? There's a huge amount of underwriting that goes into each asset. And the top 10 largest assets, we underwrite as if we're an equity owner. And same with high leverage assets. I ask, if we were to take this asset back at this investment basis, right, 70% of where the asset was just acquired by the borrower, if we had to foreclose on the loan, what would that look like? Would we be interested in owning at that price or not? And how would we operate it? And so I think it's worth noting that my background is equity, not debt. Origin's background is equity, not debt. And so we really underwrite this collateral as if we're the equity owner, not the lender. And that's a huge differentiator between us and other participants in the space today, where we were an equity buyer first, not a debt buyer.
All right, I'm going to answer a couple, but mine will be quicker. I have some in the chat, so people are cheating. I said go to the Q&A, but I'm going to answer the chat too. Thank you, Kevin and PJ. So first question, when is the next capital call? This is Kevin's question. Thank you. We usually answer in ranges, Kevin, but honestly, this time I'm not even going to give a range because it's binomial. We're looking at a lot of bonds, and we're an approved buyer, all those things, but when they come in, it's 30, 40, 50 million, or they don't. And so it's a little bit different than our other funds where we have steady streams. So I can't give you visibility. I know we just had a significant capital call. I can tell you we're working really hard, both on the primary and the secondary, but I will certainly have our team provide that when we can. PJ has a question. Do these bonds have any loans with exposure to real estate development? Absolutely not. All of these bonds are cash flowing occupied properties. So again, when you think about the stability of the collateral, number one, it's the least volatile, most essential real estate asset class, multifamily. That's why we're in it. That's why that's all we do. I talked about that before. Number two, huge protection in the capital structure, right? So you're talking about 30%, sometimes 40% losses to equity before it hits you. Number three, Tom just touched on this. As a lender, and you have to worry who your borrower is. Who's the borrower? And these are all loans that are huge loans. These are 30, 40, 50, 80, $100 million loans. The borrower are firms like Origin, firms like Blackstone, firms like Starwood. And these are sophisticated borrowers with national operations, and importantly, borrowers that value their credit. Blackstone's never defaulted on a loan. If you read Schwartzman's book, there's a whole chapter on why he doesn't do that and why he really values it. That's important. They're one of the largest borrowers in these bonds. That's your credit, if you will. And then the last thing, you're really asking this question when you ask, does it have exposure to real estate development? You're asking, does it have cash flow? And the answer is, it has a ton, right? Not only does it have cash flow, I kind of covered this on the first slide, 1.86 is your debt service ratio. It has 86% more cash flow than necessary to pay the bond, right? And so that's why I'm very confident in the safety. There's 4 legs to the stool, and that's why the stool is so sturdy. On all, you can't really find a weakness to the underpinnings of the fundamentals here. Okay, so I answered 2. I have a question from Adrian. Tom, thanks for your question, Adrian. So he's asking. He says, "Well, you know, it's interesting that you're a top decile operator, fund manager, but why does that matter if you don't have control over the operations at these properties?"
It is a good question. The reason it's important is because at some point down the road, you might own the properties, right? And you have the potential. There's really 2 components to it. You might own the properties, and they want to know that you have the ability to operate those properties and protect their collateral prior to really having you even exposed to those. The second piece is, before Origin or any BP's buyer acquires or forecloses or takes any action against the borrower, there's a long period of time where you try to work it out with that borrower. So you spend time making sure that they're operating as efficiently as possible. They're not doing anything that shouldn't be done to try to maximize value, maximize cash flow at the property. And the more strength you have as an operator, the more likely you're going to be able to help out some of those borrowers. Again, the Blackstones and the Starwoods are not going to need that support, maybe to the same degree, but they're also not the ones who are going to be in trouble. It's those that half a tier down A operator who maybe something happens to their property and they need some thoughts. They have the ability to lean on the special servicer who leans on Origin for their operational expertise. And it's really critical to minimizing the losses over time to have operators in place, buyers of BPs in place who know how to operate real estate.
Adrian had another question about mark to market. We haven't marked to market. What would trigger a mark to market? It's a great question, Adrian. Because it's a complicated answer actually. There are investment banks like JP Morgan and Wells and Bank of America that help Freddie Mac bring these bonds to the market, to their approved buyers like Origin. So we're working with those desks, first of all. We're also working with special servicers like KeyBank, who's very active in this space, to come up with valuations. Right now, there hasn't been a mark to market because there's no loans on the watch list. There's nothing to indicate that the bond would be moving. But in a world where there were loans on the watch list, we would be working with the special servicers and the investment banks to make sure that it is accurately marked. I can tell you that Origin's core value of transparency, like if anyone's a client, they know we're extraordinarily transparent, and we will be here too. That's why we're answering every question today. That's why we have the opportunity to interface with our partners. We want you to understand everything that we do in real time. There just isn't a reason to do that at this point. Okay, I'm going to move on to fund level leverage. There's a couple questions about this. The fund level max leverage for the PPM is 50%. Right now we're right around 37%, but it probably will, settle into kind of that 40% area. That's where I expect it to be. I would say relative to our competitors, we use much less leverage. But that's a choice made by us. We're willing to take lower returns in exchange for having much less risk. You as an investor need to ask yourself that same question. There are funds that use much higher leverage. In a world where everything works, you'll make more money because of that. In a world where there's hiccups, you'll be exposed. We wanted to have an extraordinarily low risk fund. And we think the returns are high enough at 6 to 8 yield and 8 to 10% overall that, you know, it's satisfying that as well. Tom, I'll answer the last question. It's because it's so easy. I get all the easy ones. Michael, thanks for your question. Will there be distributions? Yes. Will they be monthly? Yes. So I got the easy ones. You got the hard ones. That's all the questions we have. Thank you for all of your questions, really. And Tom, thank you for your time. If you do have interest in learning more, you can email me, david@origininvestments.com. I will either email you back, set up a meeting, or I'll introduce you. We have 7 people in investor relations that are very, very good. So one of those things will happen, but you can just use me as a point, david@origininvestments.com. You can also go to our website, origininvestments.com, and all of this information and accessibility to team members is there. We really value our investment partners and want to make sure that you feel heard and have a great service element. So we invest quite a bit in that process. Thank you for your time, and we'll talk soon.